Welcome to Beyond Four Walls. I'm David Dworkin, President and CEO of the National Housing Conference, the nation's oldest and broadest housing coalition. Here, we'll dig deep into the pressing topics of housing in America. I'm joined today by United States Senator Mark Warner, who has represented the Commonwealth of Virginia since 2009. Re-elected to his third term in November 2020, he currently serves as chairman of the Select Committee on Intelligence and is a senior member of the Senate Finance, Banking, Budget, and Rules Committees. From 2002 to 2006, he served as governor of Virginia. When he left office, Virginia was ranked as the best state for business, the best managed state, and the best state in which to receive a public education. Over the course of his career, Senator Warner has established himself as a bipartisan leader who works across the aisle to accomplish real solutions for all Americans. Unfortunately, that's increasingly rare in Washington these days. Senator Warner is also one of the few policymakers in Washington who has created and run a major business, having co-founded the company that became Nextel. He's also the first in his family to have graduated from college, which I think informs your approach to governing and creating opportunity as much as anything. So let's jump right into it, Senator Warner, and thank you so much for joining us.
Well, David, thank you, and thank you for the opportunity, and thank you for what you do on this critically important issue of housing.
So this is something that housing policy was a little more wonkish 10 years ago, but over the last certainly 5 or 6 years, housing affordability has become a bigger and bigger issue for more and more communities around the country. We have a database that looks at housing affordability in terms of both renters and homeownership for every occupation in the country and for every MSA in the country. And when we looked at Virginia, there wasn't a single metropolitan area where a nurse or a police officer or a high school teacher could afford to buy their own home with either 3 or 10% down. And it's really shocking because you would expect that in the Washington area. That's understandable. Arlington, Fairfax County, Alexandria. These are very costly areas with a lot of competition. But we're seeing that in Blacksburg and Lynchburg and Charlottesville. And what are you hearing from your constituents about housing affordability and how people are dealing with these prices?
It is a problem across all of the Commonwealth, and I think we can extrapolate across all of the country. Some of that is due to the fact that we've not increased supply in a dramatic way, literally for years. Part of that is some of the people staying in place during COVID. And then, obviously, the Federal Reserve's policy on interest rates have driven up the cost of a mortgage so dramatically. We maybe got sucked into the regime of easy money, thinking there would be interest rates at 2 to 3% when we could get a mortgage for under 3% there for a while. That was historically an anomaly. On the other hand, getting rates now in some mortgages in excess of 6 or 7%, that may be historic, but boy, that's a shock if you were used to interest rates at half of that. So one of the areas that I want us to look at are increasing supply, how we can deal with building equity in homes, how we can incent and provide that teacher or nurse or firefighter a tax break to get down payment assistance, for example, from an employer. We've got something we've worked with you guys on. I'm very grateful for your help and ideas about, we call it the Live Here tax credit that would allow an employer to get a tax break that would not then show up as income to the worker, where the employer could do up to 20% down payment assistance. Up to 10% down payment assistance, not to exceed $200,000, as a way to giving those folks a chance to live in the community they work in.
Which is really incredible. And I have to say, I've had a lot of meetings with elected officials over the years. I've never had one where I talked about an issue that was a little wonkish. We're talking about employer-assisted housing, the way that employers can offer that down payment assistance. They often tie it to multi-year forgiveness that helps ensure that the employee stays in their company. Really a big deal in terms of turnover, especially in this economy where so many employers are competing so ferociously for workers who are available in their communities. And to be able to talk about that and then have a senator just turn around and say, well, what do you need in terms of legislation? What can we do about that? And to pivot then to one of the key issues there, which is that employees who get the benefit have to pay tax on it. And the employers aren't getting a tax break. And, within a few weeks, you've got legislation drafted. You're talking about who might co-sponsor it. That is not the experience most people have up here.
But you had a great idea, and this was a reasonable solution. I think we've seen traditional programs that provide down payment assistance coming from the government. They're good. I've been supportive. But with the current House of Representatives and with some of my Republican colleagues, that's not going to happen. So the idea of giving this benefit to the employer to then be able to pass on to the employee, and that ability to kind of have the employee retention. I mean, this one makes sense, and I was happy to try to start us on the path of getting it, hoping it become, hopefully becoming law.
I appreciate that, and it really harkens back to Build Back Better. We had $10 billion in down payment assistance. We also had the LIFT Act. We're going to talk about that in a minute. Two different angles to improving wealth creation, but Build Back Better wasn't passed, and passing that kind of getting that kind of money approved by Congress is never easy. It wasn't easy when the Democrats controlled both the House and the Senate. Now we have an even more partisan scenario. And so leveraging and harnessing the ability of the private sector to deal with the problem that the private sector is also facing, I think is really important.
Well, I think one of the things that we both know is that during COVID, where we were putting out under both Trump and Biden, close to $5 trillion. Much of it, I absolutely think was needed, and we provided some rental relief. But in all that money, other than the rental relief, and foreclosure relief, there really was nothing that spurred additional housing supply. And housing was, as again we've discussed, was the one area that, oh yes, we'll get to it next. And as with so many things up here, we're sitting in my hideaway in the Senate, that next sometimes never arrives. So we got to think differently on housing supply, on affordability, on wealth creation. And, I hope some of the ideas we're going to talk about, as well as support for traditional things like low-income housing tax credit and some of the multifamily housing tax credits that need to be renewed. I hope this angst around housing we can translate into actually making new laws.
I think one of the most frustrating things that I've experienced in the housing world is that leaders in Congress and the administration will often tell you how important it is, and they mean it. And we're in their top 10 list of things to get done. And then 3 get done. If you're lucky, it's 4. And you were number 7. And so housing is quite a collection of participant ribbons. But I think that the higher prices go, the more people are struggling, both with rent and to become a homeowner, the more policymakers are saying, we really need to deal with this. This is something that I'm hearing more and more about. My kids are, and their friends are hearing more and more about it.
Absolutely. My kids are late 20s, early 30s, and they're in that stage. If they didn't have some assistance from me and my wife, I'm not sure, how they'd make their housing needs, get their housing needs met, and not every family can provide that kind of support for their kids. So I'm very fortunate. But it is an issue. You got supply chain issues around housing. You've got inflation issues. You've got the higher interest rates. All this has created kind of a tsunami of effects that really make it very difficult for homeownership, and for that matter, even for affordable renting.
Yeah, that's for sure. And, you mentioned being able to give your kids that help. And I, was not the first-time home buyer in my family. My father was. He benefited from the GI Bill of Rights. He served in World War II. He was able to get a VA mortgage on his first home. He was the first person in the history of his family to own their own home. He went to college on the GI Bill of Rights and helped in terms of his tuition. And that began a process of building intergenerational wealth. And, I often say, I got the daddy down payment loan, but everybody doesn't get that. And it really also comes down to this issue of both privilege and racial equity. There was a corporal who he never met because he wasn't allowed to serve with him, who did not get to use his GI Bill of Rights. He wasn't allowed to go to the colleges that my father was able to go to. He wasn't allowed to get a mortgage in the communities where my father was able to buy. And we think about that as historical legacy of discrimination. But the reality is that I grew up with a presumption that I was going to be a homeowner. I grew up with advice from my parents, and I grew up with the ability to get support, whether I used it or not. And so many people of color do not have that. And that gets us into the whole issue of the wealth gap. Tell me a little bit about
Absolutely.
that.
And let me just add quickly on my personal family. My dad was Marine in World War II, and he took advantage of some of those benefits around housing. And although I was saying to some of my staff yesterday that I think the most expensive house we ever lived in had a big purchase price of about $20,000. So I still remember living in a neighborhood and we'd sometimes point out the house that cost $50,000, and that was like the mansion. How times have changed. And I think what you talked about in terms of racial wealth gap, unfortunately, it is about 10-1, white families over black families in terms of total assets. The total assets of most black families on average is literally down in the teens in terms of thousands of dollars of wealth, whereas it's six figures for most white families. And that's what really motivated me to look at our initiative that says, rather than simply looking at down payment assistance, can we look at wealth building? And we have legislation that would say if you qualify for a 30-year mortgage and can make those payments. Now, again, we would sanction this only for first-generation home buyers. So by definition, that almost becomes 2/3 people of color in this country. We would, through Ginnie Mae, provide a subsidy that would in effect say if you can meet that 30-year mortgage payment, we'll provide you actually a 20-year mortgage. So that would mean you would accumulate twice as much equity within a 10-year time frame. So I think it's a good idea. It was interesting at first. We had to convince folks in the civil rights community that this made sense because I think they have traditionally put all of their eggs in the basket of down payment assistance, which I'm supportive of. But this kind of dual approach, let's do down payment assistance, but then also let's do wealth accumulation. And the civil rights community has come around now to be supportive. I think this is, again, a new kind of idea that I think would offer great opportunity.
Well, I think the reason they were supportive and I was involved in this is because you were very responsive to their concerns and worked on the legislation with them and made some adjustments that really made a difference and I think are a model today in terms of how we think about making benefits available to people who need it the most, but also playing down the middle of where the Supreme Court is likely to find constitutional. And we have a very conservative Supreme Court, as you know, and many areas of how we've looked at racial equity in the past are getting struck down.
And that's why we ended up with that definition. Again, you helped us work on this around first-generation, first-time home buyer, rather than saying we're going to identify this, purely for minority buyers or one class, because as you said, passing muster with this Supreme Court is a challenge.
And it's also politically smart, I think, because there's a lot of members of Congress. They may not have large minority populations, but they have plenty of people who have never been a home buyer. Nobody in their family has been a home buyer. They may come from lower income congressional districts or states where there's a lot of rural space. And people in rural communities throughout Virginia are also going to benefit from this.
We see this a lot in Appalachia, where most of those families are white, but the wealth gap between families in Appalachia and families in Northern Virginia mirror very much the wealth gap between white families and black families. So to your point exactly, that you don't have a history of home ownership in a lot of communities. And as you touched on as well, this lack of affordable housing or any kind of housing in rural communities has been an area that also has been ignored for a long time.
Yeah, and that actually segues into the Neighborhood Homes Investment Act, which you've recently co-sponsored, and we really appreciate that, where we always think, and we've been talking about areas where housing prices are so high, but there are also communities and also areas within cities that housing prices are actually too low. It's hard to get your head around that, but they're run down. They need a lot of work. We may need to build new housing in these communities, and the amount that house is going to appraise at after we do the rehab or after we build it isn't going to be high enough to cover those costs. And so, and this gets to your membership and leadership on the Finance Committee, developing a tax credit that's going to actually close that gap will allow us to open up all kinds of housing production options in communities where we haven't been able to do it.
Right, where we've got this, in many cases, dilapidated housing, many times, as you said, in older urban cores. Rob Portman and Ben Cardin, and we miss Rob here in the Senate. He was a former senator, Republican senator from Ohio. Took the lead. I picked up some of the reins on it more recently. Because if you can do that fill-in housing, even though it may not pencil out directly for the community, it's really helpful because it revitalizes old neighborhoods. It also means that for the local community, they've already got water and sewer. They've already got streets put in place. It's easier to pass broadband, whereas opposed to the new suburban development, has to, for the local community, has to build that all in. So I think, again, this is one of those area where you try to strike the balance between traditional programs, new programs like this that would fill in the gap, new programs that would fill in, calling on the private sector to provide breaks for, so that employees can live in the community they work in. And again, some of our Lift Up Act, which we talked about a few moments ago, that tries to deal with the wealth gap issue. I think you've got to have this menu of options.
When we think about Lyft in particular, I think that most people who have a mortgage don't understand that when you're paying nearly all of your payment towards interest in the beginning of the loan, and then you're paying more and more to yourself in the end of the loan, that you're not going to build equity as quickly in the first 10 years that you own that house. Changing that from 30 years to 20 years, which was actually what FHA originally was, changes the dynamic very rapidly. I mean, it's quite dramatic. And so
it really translates at the end of 10 years, you've got twice as much equity.
Absolutely, twice as much equity
as you would have had if you've been in a traditional 30-year mortgage. So it's really important, and that equity can then be obviously cashed in when you sell, but also you can borrow against if you need to give that kid the college tuition, or you need to give that child, the help on a down payment assistance for next generation. It builds that individual family's wealth. That, again, we all know homeownership. People treat their homes if they own them differently than they do if they rent, and there's just a lot of good social benefits that come from that.
There sure are. One of the things that we've also been working on is the low-income housing tax credit. This focuses on rental units that are financed in part by equity that's created through the sale of these tax credits. And one of the things I think we often forget about is that by building low-income housing tax credit properties in communities, we often create opportunities that allow us to have more diverse communities, but also in terms of income and markets. More density means more consumers. And this is part of what I think is lost in the NIMBY issue. People are like, oh, I don't want, low-income housing anywhere near my community. But in reality, it doesn't work like that. And I think that one of the things I often say to people is, if you don't want lower moderate income housing in your backyard, you're going to end up with homeless people in your front yard. Right. And we've seen more and more of that.
More and more of that. And again, one of the things I like to remind people as well is that when we think back to the financial crisis of 2008, 2009, where there was a lot of problems in the housing sector, the one part that didn't fail was the multifamily housing in terms of Fannie and Freddie and Ginnie and all of these housing finance entities. There were a lot of problems in single-family mortgages that defaulted. There was very little of that. The health of the multifamily sector has always been strong. We just need to put some new incentives in there to keep that supply current, and that's where we've fallen behind a bit.
Well, and you bring up Fannie Mae and Freddie Mac, and one of the things we share is several years of our lives spent trying to figure out how to do that differently, do it better. It's I don't want to trigger any PTSD in myself or yours, but as we look at that now, they've been in conservatorship since 2008. It's 2023. What do you see now is the future there? One of the things I think I've become increasingly appreciative is we actually did a lot of good work in the HERA bill right before they went into conservatorship. It allowed them to go into conservatorship, created a new regulator. How are you thinking about that now?
There are very few topics that are as complex as housing finance, and trying to understand it all I felt like it was a graduate course on steroids. And again, my partner on that was a Republican Senator, Bob Corker, who also unfortunately is retired. I think the idea of turning these entities more into the utility model, I think makes some sense. My concern has been whether my Republican friends would go along with that. Some of them, I think, are more open because the conservatorship long term, I still don't believe is the answer. One of the things as well that I think the entities have done in terms of their duty to serve, to make sure that there is some level of, low-income housing funds to make sure that everyone gets access to mortgages. That's been kind of a squishy. It's a mandate for the entities, but it's been a little squishy in terms of tracing the actual dollar amounts. One of the things that again was pretty frustrating in our reform efforts were that we would put a 10 to 15 basis point fee on any mortgage that was guaranteed or securitized by these entities. And that would go into a dedicated pot that would generate somewhere between $4 to $6 billion a year that would go to the things like the National Housing Trust Fund and other initiatives where you could actually have, I thought, again, accountability, and you could really make sure we're getting the bang for the buck in terms of underserved communities.
So one of the areas that has made a difference in economic development that you've been involved in for a long time are CDFIs. Tell me a little bit about what you've been doing in the CDFI. 20%, no one group of NHC's membership is more than 20% of a sector in the housing world. And the largest is nonprofit housing developers, which is about 20%. Many of them are CDFIs, and you really recognize the importance of CDFIs in the whole equation.
Well, it came about for two reasons. One, back when I was governor, I was very concerned about how we get access to capital, not only for housing, but for small business and in communities that were more rural. And we created something called the Virginia Community Capital, which is a depository CDFI, kind of bank-like in function. And proud to see that grow over the last 15 years to become one of the more successful CDFIs across the country. Fast forward to COVID, and we had this successful initiative called the PPP program, where there was loans to small businesses to get them through the COVID period. What we found, at least with the first round of PPP money, was that funding going to Black and brown businesses were really not meeting the needs, not because I think, again, on this case at least, not because of inherent racism, but because we were using as the mechanism to put out the PPP money traditional banks. And many Black and brown businesses, and for that matter, some rural businesses, didn't have access to a traditional banking relationship. They may have bootstrapped their business together and never gotten a loan. So CDFIs, which again, by definition, have to serve 60% low and moderate income individuals, is a area of the financing system. And there are CDFI grant funds, there are CDFI depository institutions, there are CDFI credit unions. This is a sector that was about 1,600 of these institutions in the country. But really kind of overlooked and relatively small part of the overall financial sector. So in a strange bedfellow arrangement, I worked with then President Trump Secretary of Treasury Steve Mnuchin and with Mike Crapo, who was a good friend and now co-chair of the CDFI caucus we have in the Senate. And we were able in the last COVID bill under Trump to get $12 billion into these institutions, $3 billion in grants, $9 billion in tier one capital, which almost doubled the whole capital base for these hundreds and hundreds of institutions. And in subsequent rounds of PPP, there was a much fairer distribution of those loans because we are starting to use CDFIs as part of the delivery mechanism. Long term, this sector I'm continuing to focus on. I think it is important for housing, but it's also important for small businesses. It's also important, as you said, for some of the multifamily guys and gals. And we have created a CDFI caucus in the Senate, 24 members, 12 Democrats, 12 Republicans. It's hard to have that kind of balanced large caucus because, again, in a lot of CDFIs are in rural communities as well. And then we have also created, in a public-private initiative with help from the Biden administration, Wally Adeyemo, the Deputy Secretary of Treasury, something called the Economic Opportunity Coalition, to go to corporate America, many of who promised a lot to deal with, poverty and racial reconciliation after the murder of George Floyd. They promised big numbers but didn't deliver. So now we're going back to these corporate Americans saying, hey, we want to make it easy for you to honor your commitment. And one way you can do that is by putting patient capital into CDFIs as deposits, because it's great if you raise the equity for these institutions, but you also have to raise the deposits so they can be lent out. And you get the magic of leverage and all of the things that make the financial sector tick. And we've had some success. And now we're trying to also see if we can support for CDFIs a secondary market. I mean, again, one of the reasons the housing market has been so successful has been the whole question that you bundle up a group of mortgages with an appropriate credit rating, sell that off. That means the banks get their money back and they can then recirculate it because CDFI lending is pretty more bespoke, more kind of individually tailored or project tailored. There's not been the ability to create the secondary market of taking their debt, securitizing it, selling it off to another entity that would then put the money back into CDFIs so they can relend it. It's a long way around saying that is one of our goals as well, to see if we can, not only get patient capital from corporate America into CDFIs, but also see if we can then create a secondary market on their debt.
And that's great. You have an interesting timing. The time that you were governor was really the rise of CDFIs, I think, in communities around the country. It was created in the 90s, but there was a ramp-up period. The Community Development Financial Institutions Fund, where I worked for 2 years at the Treasury Department, and also the Low-Income Housing Tax Credit was funded in the 86 bill, but that market also grew significantly and really came into its own in the early 2000s. As the market for equity increased and the amount of subsidy being able to go into these deals increased. We're at a bit of an inflection point now. And one of the issues that we're seeing is how capital plays into this, how these programs are able to thrive in the Community Reinvestment Act assessment areas that encourage banks. I'm going to be with Vice Chairman Barr later in the week, and we've been talking about the new CRA regulations, which really seek to modernize CRA. One of the things that, we talk about are bank branches. I don't know when the last time you were in a traditional bank branch.
Been a long, long time.
It has for me too. And my bank branch is on my phone. It's an app. And I actually bank with a traditional bank and a credit union, but I make all my deposits there. I move money around. I pay my bills there. And I'm not the only one. I think this is also true in all kinds of communities, at all kinds of income levels, and at all kinds of ages. I taught my mother my mother's 92, and I taught her how to do her deposits on her phone. Mm-hmm. And she was saying, why didn't you tell me about this 5 years ago? And I said, well, it didn't exist 5 years ago. So we're in the 21st century. We've got a new CRA regulation. We're all digesting that. We also have capital rules that have a unfortunate twist, and you've had some views on this. I think it's very timely. New capital rules that say we're going to actually charge more capital for banks that are doing the very kind of lending we're trying to encourage them to do in these underserved communities. And it's hard to understand.
I'm with you. I think I have some concerns about what Vice Chair Barr has put out on these new capital rules, because we may have been hitting kind of a perfect storm where the higher capital rules are hitting at the same time we've had inflation and interest rates at high levels, which means it's even harder to get a loan again. And then you've got this once in a generation, at least in the commercial real estate market, where a complete transformation of where and how we work is going. And these three things could actually converge and become a disaster. And I just worry that the higher capital rules, one in comparison to, for example, competition with some of our European banks, this would put our numbers much, much higher. That's a concern. But it's also a concern that we saw the run on Silicon Valley Bank, and that run took place because it was internet driven, with certain key investors, I think, doing the equivalent of yelling fire in a crowded theater. And that bank lost about 25 cents on every dollar of deposits within 6 hours. No capital requirements are going to have enough buffer
Not at all.
To deal with that kind of internet-based run. And one of the things I want to talk to Vice Chair Barr about is, if we're concerned about the stability of our financial institutions, one of the tools that were created when the Federal Reserve Bank was created back in 1913 was access for banks to go to what's called the discount window, where they could borrow at a very low cost from the Federal Reserve if they've got that liquidity problem. Now, over the years, having a bank use that tool has been kind of a almost mark of shame, and the financial markets have dinged you on that. I think we got to change that. And that's what I've said to the banks is, if you can't complain about these higher capital requirements and then not use some of the tools that are existing. So how we could make it more general rule of thumb that banks would access the Fed deposit, the discount window on a regular basis, might get rid of some of that stigma, and that might ultimately diminish the need for these higher capital rules. I know that's kind of complicated, but this whole sector is kind of complicated, but it's something we have to sort through.
It is. And when I talk to people about capital, I say, we want to encourage banks to hold capital because it's the same thing as having a personal balance sheet and keeping money in savings. When things go wrong, you want to be able to draw on those savings. But if you put so much money into your savings account that you can't actually touch, that you end up constraining your ability to live day to day, that's a problem. And for banks, the more capital we ask them to hold, the less they're going to invest, and the more they're going to choose to invest in areas where they're going to get an easier return. And that means they're going to invest less in the communities we really want them to invest more in. And it's simple math. I want to say I'm a big fan of Michael Barr, strongly supported his appointment to the Fed, worked for him at Treasury. Think he's done amazing work on CRA and following up with Lael Brainerd's work there. She's now in the White House, has really set CRA up to be sustainable and make a difference. But I don't have any friends, and I certainly am, this is true of myself, who get everything right. And with this Basel capital rule, I'm really worried that they've got it wrong. One of the ways they've got it wrong is they've ignored the areas where they've been incredibly successful. We keep hearing about 2008, and you were a big part of putting into place the Dodd-Frank Act that made a big difference and has created really systemic improvements that are historic. And many of these regulators worked on that too. It's as if that never happened. With Silicon Valley Bank, I think you understand better than anybody the importance of having a bank that deals with very large deposits for startups. We need banks like Silicon Valley Bank. We need them to understand how to manage interest rate risk.
Right.
And they clearly didn't.
This was plain old Prudential 101 violation with Silicon Valley Bank.
You can't regulate for stupid.
You can't regulate for stupid. And also higher capital alone would not solve that problem, especially when you saw the run that took 40 some odd billion dollars out in 6 hours. 25 cents on every dollar. I think we need some new rules about the people who yell fire in a crowded theater. But we also need some of these tools like the discount window, which is already in law, but that being used on a more regular basis by some of these institutions.
It is funny how, one of the things I show all my new employees is the run on the bank scene in It's a Wonderful Life. Mm-hmm. And it is shocking. Here we are in the 21st century, and how much can we still learn from watching a movie that's, 80 years old.
Right. The idea that the bank doesn't have in their vault all of your money because your money is being put to work in hopefully good loans made to other folks. That's the whole notion of banking. Yeah.
And people talk about how, it's so different now. So many millions and billions of dollars were able to be withdrawn in such a short period of time. But when the numbers were much smaller in the 1930s, it didn't take long for people to line up at that bank.
People had a run. That's where, during the Depression, where they had to create literally bank holidays, as some listeners may not personally recall, but if they've read their history, because folks lost confidence in the institutions. Again, and where I have a great deal of respect for Michael Barr as well, I'm not sure simply higher capital rules that may put us at a disadvantage on a global competitive basis really are going to crack that code.
So the last thing I want to talk to you about is partisanship. We just went through an experience with the Speaker of the House where the Speaker was removed basically because he agreed to work with the other side on a temporary move to avoid shutting down the government for a temporary period of time. It's a little shocking. People are primaried today simply for agreeing to talk to and work with on some of the most rudimentary political issues, Democrats or Republicans. And we see this on both sides. We've been paying a lot of attention to what's been going on in the Republican Party. But as you know, there have been Democrats who've been primaried for working with Republicans. I'm sure you get plenty of heat for that. What do we do about this?
I'd ask everybody to go back and read the Constitution again.
There's
the founders set up a system of government that, with checks and balances, that required you to get to yes. And the notion, particularly in the House, and both parties have been guilty of this, that they're only going to pass bills with only their own team is crazy. I was so disappointed in the last almost government shutdown where there was some bipartisan agreement finally on the issue of Ukraine. I think it's terribly important that we support Ukraine. There an overwhelming majority of the Democrats and at least half the Republicans in the House a few weeks back, even more than House, supported that. But the idea that an extreme group could prevent that from coming to the floor is crazy. That's one of the reasons why, in the Senate, I've had lots of folks in my party say, Warner, change the filibuster rules so you can pass bills with 51. I did agree on voting rights because I thought protecting the rights of the minority in the Senate didn't trump protecting rights of minority voters to get access to voting. But for the most part, my best days in the Senate when we were passing the CHIPS bill, when we were passing the infrastructure bill, when we were working on some of the energy changes in the IRA, all those came about because there was a bipartisan group of us that came together because it requires 60 votes. When I talked about the CDFI money, that was in the last Trump COVID bill. There was a gang of us that came together on that bill as well and wrote most of it. So I do think bipartisan, one of the reasons I like bipartisan legislation is not because it's intellectually better necessarily, but it does mean both parties then have to own the result. And chances are, no matter what the bill is, if you're just doing it with one team, you're going to make mistakes. Chances are, even if you're bipartisan, you're going to make mistakes. You can't fully predict the consequences of every action. So if you've got a bipartisan buy-in, you got to then have buy-in on coming back and fixing the mistakes. We've seen, when the Trump tax cuts that were all done with one party, or unfortunately, for the most part, Obamacare was done with just one party. The other party, Republicans in the case of Obamacare or Democrats in the case of the Trump tax cuts, felt no ownership, so there was no willingness to fix where some of the excesses were.
We so often let the perfect be the enemy of good, and there is no such thing as perfect.
And there's no such, especially in the sausage-making business of legislating. And again, I still think most Americans, maybe not the extremes in either party, but most Americans, when they hear a bill is bipartisan, they tend to think it's more actually in the best interest of the country. Again, that doesn't always have to be intellectually the case, but because I think most Americans don't fully trust either party to have all the answers.
Yeah, unfortunately, that's the case. But these things ebb and flow over time. Congress has been much more partisan in the past and much less. And I think that where we are today is never going to be the same forever. We were in a different place before. From
your lips to God's ears.
Well, I hope
that's at least what I think we all hope.
Yes, the problem is what time. I think, people say, well, I know interest rates are going down. I just don't know when. And if I knew when, then I might be doing that instead of this. I know that we're going to get this right, and Congress is going to be less partisan. I just don't know when. Hopefully it'll be sooner rather than later.
Well, David, thank you so much for having me. Thank you for your good work. Thank you for helping me and my team sort through particularly some of these issues around housing. I do think we will put points on the board. I hope and pray it's going to be this year on housing because we can't keep kicking the can. We've got too many stories, as where you started, where and this is not just Virginians, but Americans everywhere can't afford with what used to be middle-class jobs to buy that home or to live in the community they work in. And we've got to make sure that's part of the American dream that we all have a chance at.
And it's a great note to end. And thank you. Thank you for your leadership. And, it's great that we come up with these ideas, but we need senators like you to make them happen. And I appreciate that.
Thank you, David.
Thank you for listening to this edition of Beyond Four Walls. You can visit the National Housing Conference at nhc.org. There you can learn more about affordable housing policies, affordability challenges throughout the nation on our Paycheck to Paycheck database, and explore membership in NHC for you or your organization. We appreciate your interest and look forward to working with you in the future. Until next time, I'm David Dworkin, NHC's President and CEO, wishing you a great day.